How you doing, friends? It is another new week in Zero DTE land. And this morning, just like every Monday morning, we're going to do a clean slate volume profile analysis to determine the market structure. We do this every Monday, redo everything. This week might be a little bit different than most other backdrops for the profile and for what we're evaluating. So let me just explain. We're doing zero DTE, 0 days to expiration. We trade the very last day of options on the S&P, both the ES or the E-mini futures and also the SPX. We do our evaluation or our technical analysis is all done through volume profile. And we use the E-mini futures as the conduit for doing that profile analysis because the SPX is a calculated index. It has no volume, so it's impossible to do a volume profile analysis on it. So we do it through a surrogate, the S&P E-mini futures contract, because it does have volume. And it also trades 24 hours a day, so it gives us a much better view. Now, the E-mini futures contract, like most other, all other equity futures contracts, has a quarterly lifespan. So there's a March contract, goes from December to March. There is a June, a September, and a December contract. And right now, we're in the middle of what's called the rollover from the September contract to the December contract. Now, when that happens, there is a disparity between prices for the E-mini. Now, when you go to a chart like TradingView, you're typically looking at something called the continuous contract, which is an average or a calculated amalgamation between the two contracts because they're not always showing you exactly on that transition one contract or the other. I know that sounds confusing. So exactly what it means is that in a continuous contract, you're not getting the exact price of the index that's currently being traded at its highest volume. So the way this happens in the real world is that futures traders are out there and they're trading both contracts. They can run simultaneously. And when you get to the start of or the end of one contract, futures traders will decide, well, what is called the front contract or the one that they prefer to trade. And so you can see that in the volume. So for instance, when it was 2 weeks ago, all the volume would be on the September contract and very little volume on the December contract, right? So here's September, here's December, right? And then as you get closer and closer to the expiration of the September contract, that volume starts to do this, right? And then one day, or maybe over the course of 2 days, depends on the futures trader's algorithm or preference or whatever, all of a sudden the volume shifts like this. And then the September contract then only has a few days left and then it goes away. Of course, there's always the next contract that's coming up too, the next March contract. It's in play, but its volume is now very, very little. So now you have the new December contract and then the 2023 March contract that's way down here. So that's how it works. And that transition from volume to volume is called a rollover. So we're in that rollover week. Now, from a trading point of view, from an options trading point of view, we're still trading, even though the volume has decreased tremendously on the September contract, the futures contract, we're still trading the options on if you're trading the E-mini on the September contract. Now, in fact, we trade primarily the options on the S&P, but we're still doing that analysis. So it's a little bit hairy. I know that all sounds confusing, but it really isn't. We're simply using the pricing, and you'll see on the volume profile. Let me just go to it. We're still using the pricing of the September contract because that's what's significant to us. And let's see. So, for instance, if I go to the SPX, which isn't open yet, so I don't know what the pricing on it is yet. But this is the SPX. It isn't open yet, so it's at 40.67. That's the closing price from last Friday. This is the December contract, which is currently at 41.04. And this is the September contract, which is at 40.86. So you see that there's about a 15-point difference. So in fact, the December contract is 15 points ahead. And I guess that's basically the futures market saying that they believe that the market is valued 15 points higher. I guess that's one way to look at it. But in any event, the SPX will be close to one of those. And so we have to make that calculation in our head and exactly where levels are. But it's not so difficult because all we really care about is the approximate levels, although a 15-point difference can make a lot of difference. So we'll have to wait and see what the SPX comes up with and whether or not we should be doing our evaluation on the September or the December contract. So right now we're sticking with the September because that's what has been working right up until last Friday and right now. And of course, we don't know what the SPX is going to show when it opens, but we'll see. All right, so now that I got all that out of the way, and it is a little bit confusing, but that's the life of futures contracts. And anyways, what we have here is the September contract for the E-mini, and we want to do a volume profile analysis on this. And it's pretty simple. We're trying to discover the structure of the market. And the structure really is all about identifying where potential orders are in the market, where the market players, the institutions, and other, investment houses and professionals have the majority of their orders set up, and generally they're protecting previous orders or previous positions or other levels that are important to them for whatever reason. Now, when you look at the entire market as a whole, you don't really have any strategy that determines this. It's just something that happens organically, and that's why we have these different nodes showing where volume has been prevalent at certain levels and not prevalent in other levels. But none of that really matters as to the why. All that really matters is that they're there and that we identify them and that we mark them up, and then we use that markup as a way of identifying the structure of the market or where those orders tend to lie, because where those orders are is going to be where there's going to be some sort of inflection point of price, resistance and support and that sort of thing. So that's why we do it. All right, and it's pretty simple. For nodes, I simply draw a rectangle at the steepest incline of the node itself. Now I've exaggerated these nodes so that they stick way out, so they're easier to find that steepest point. But on this node here, that's centered at about 41.34, 35, it looks like, if I drew a rectangle right about there, that's approximately where I'm going to find the steepest part. And so basically what that's saying is that I'm presuming then that orders are going to be stacked up around the top part and the bottom part of that box, approximately, within a couple of points. And you'd be surprised. So if you went out and used a tool like Bookmap or something, you would see that. And so I'll mark up all the nodes that are close to price and where I think price might be going. This is kind of a minor node, smaller. I call these child nodes. And then sometimes, like the one below this, they become kind of bifurcated or trifurcated. Let's see if I can get this. There we go. Copy and paste it, put that right down here. Yeah, that's pretty close. All right, so once I've identified the major nodes, that's part of the job. The next part is identifying what I call what a lot of people call the LVNs, or low value nodes, which is the mirror image of a volume node. And that's the low points. I call them LVLs because there can be more than one. And what we're looking for are these extreme low points. And we're going to identify those with a green line. So I'll use a horizontal ray for that. And these are other points where institutions and investment houses and professionals are lining up their orders. And these have a very specific behavioral aspect to them when price approaches these very, very low points. They almost act like gateways between nodes. And they either allow price to move through them and to the next node, or they reject price and send it back to the previous node. And from a big picture market price action point of view, you can think of the volume wells, or these areas of low volume, which also have low liquidity, as those are the areas where the market tends to trend. And then, of course, the volume nodes are the areas where the market tends to consolidate. All right, so we'll start by picking these off in areas that are close to us. So I pick out the very lowest points. Like that right there is a significant area. And like I said, there could be multiple areas. You can see that there's definitely an area right there. And when we zoom in, you'll start seeing that price will be respecting those specific levels. It's kind of weird, but that's how it works out. And that's how we create our analysis. And it's actually quite accurate. So I'll do it above and below the closest node that that price is near right now. So sometimes it's not that you want to get it right in the middle of that. It's best to get it right on the edge of one of these. So like this, right about this edge is probably good. At least that's what I found. Right there. All right. So that's good enough for now. And that will probably serve us for the rest of the week. Now, when we zoom in, we may not be able to see these value nodes, because what will happen is, because I'm using the visible range feature of TradingView, when I zoom in, all of this other price action that's out here on the left is going to go away, but what will remain is my markup, so that I can see exactly where those nodes were. All right. All right. So when we're actually working from day to day, we're usually in like a 15-minute or a 5-minute. All right. So here we go. So we see where the nodes are, and you can see that there's some overlap of this more recent action and volume. All right. So the next thing that I do is I also name the nodes, so that when we're talking inside the group, we know what we're referring to. So I put the one that's closest to price. I call that T with a number suffix on it. and T for target, because generally the nodes are where price is attracted to. And so I'll make that T0. And then I'll make the other one, which I think is less likely to be visited today or soon. I'll call that T1. And then the other one, if I zoom out, let's see, I can call that one T3. I don't really need to do it, but I will do it anyways. Let's see, where is it? It's up here. This one we'll call T2. T2. All right, now that's it. And then, during the week, I will look at price action and where it is and what type of entities are coming into the market by economic reports and our global macro analysis, and we'll determine where price is likely to go, where, our bias on direction and magnitude of that direction. And then we'll draw up scenarios between these market structural lines, and usually draw up both a bullish and a bearish scenario. And then from that, each day, once the day develops, usually in the late morning, we can have a pretty good idea which scenario is probably the predominant one. And then from there, we can create our trades. So that's how it works. There you go. There's our volume profile market structural analysis. I know that this is probably quite different than the way anybody else does it with volume profile. That's because they are wrong and we are right. I have no idea why they do this sort of thing, but this is basically how, as far as I know, and because I've been involved in it, how pros do it and how it's been done for ages. All right, and it's all derived from market profile, which is a whole separate discipline. And market profile has some other aspects to it that I think are just total voodoo and have very little meaning. So, for instance, value level high and value level low is completely arbitrary. Point of control, not completely arbitrary, but it does not provide support and resistance like a lot of people think it does. The edges of the nodes and the LVLs, or the low value areas, are the most important parts of the structure. Now, the one other thing that I like to do is I like to also identify this whole area as a volume well. And if there are multiple ones in the area, then I want to distinguish between them. So we'll call this one volume well number 1. All right, and then the one above it, I'll call it volume well number 2. Again, just so that when we're talking inside of the service in the trade room, and we're referring to these by name, everybody knows what we're talking about. And every week we go and we do a brand new analysis. I guess you could say that the one below is down here is volume well number 3, but it's not as well defined right now, so we'll put it there anyways. I don't think we're going to get down there soon. I actually do think that we're probably, it's kind of up in the air. Are we going to go to T0? Are we going to go to T1? I don't know. Are we going to continue higher? Are we going to enter into T2? Don't know. But we'll see. We'll see how the market progresses, and we will create our... What are you doing, dog? The dog's biting his nails. And we'll see how the market progresses, and we'll develop our scenarios, and then we'll go from there. And you'll be able to see that at the end of each day when we do the final hour trade. You'll see the results of our trade for that day, and then the analysis and the scenarios that we created from the market structure. So there you go. All right. Thank you very much. Let's get back to the big head. Here's the big head. Thank you very much, and we will see you later today on the final hour trade at about 3:15. Take care. Bye. Peace.
Bye.